Welcome. We're here today for this episode of Village Talk. I'm Shannon McNulty, founder of the Village Law Firm, a boutique estate planning firm in New York City with a mission to provide peace of mind to New Yorkers and their families. So thanks for joining us. We have a great guest today. Danielle Barrett is the partner and client advisor at Brown Advisory's New York office, which is an investment and strategic advisory firm. She is responsible for managing client relationships and advising them holistically on investment strategy, estate planning and tax, and philanthropy. Thanks so much for joining us, Danielle.
Thanks for having me.
So today we're going to be talking about something always I think people are interested in. How can we maximize the amount of money that we're bringing home and putting in our pocket or our bank account, and minimizing the amount that we have to pay in taxes? So I know that this time of year is a really good time to look at those issues. So if we haven't addressed them throughout the year, then this is something that we want to look at before January 1, because once December passes, the end of the year closes, then the opportunities may not be available anymore. So I invited Danielle here today to talk about some of those opportunities. What do we want to be on the lookout for, Danielle? What are some of the things that our listeners should sort of check off their list and see if there's anything that they can do to minimize the amount of taxes they'll be paying in April?
Absolutely. Well, thank you again for the opportunity to join you today. Before kind of highlighting the 4 areas that we think really move the needle the most at year end, I thought I might just highlight how we think about this time of year. And traditionally, it's a time of reflection. It's a chance to sit with clients, review progress, and discuss the events shaping the investment landscape, and potentially revisit goals for the near and long term. And ultimately, 2022 was a pretty painful experience for many. On a geopolitical front, the world's grappling with an awful war in Ukraine, and the many global implications of that war. The domestic political backdrop in the US has divided our country. And although many have emerged from the pandemic, we're still feeling a lot of lasting effects. So in brief, 2022 was a really challenging year. And particularly from an investment perspective, that really leads into some of the things that we can control heading into 2023. So the first item that I'll mention is tax loss harvesting. This has been a strategy that in many years prior to this year has been really hard to utilize. And while none of us, especially on the investment side of the table, want to see a stock value drop below its cost basis, such a decline does present an opportunity to bank a tax deduction by selling the stock and creating a tax loss that can offset current and future taxable income. And the nice part about that tax loss and recognizing it in a year like this one is you can carry it forward. So even if there isn't a need to use it this year, if you don't have gains to offset the loss, you get to keep it in the bank and hold on to it like an asset for years to come, where you inevitably, we assume, will have the gain to offset those losses. And typically the way we think about this is if it is a security that you want to hold in the long term, you can buy some sort of a passive index and in the interim, and you can repurchase a security 30 days later after having sold it. We've seen that markets this year, and in particular, the last 3-4 months have been so incredibly volatile that we do want to make sure that if you're selling a security, you do stay invested in the market, because 1 or 2 days out of the market can really change what your overall return can look like for the year. So that's really the first and most important strategy that we've been talking to clients about this year. And the second
Great.
is,
Can you, just before we move on to the second one, because I want to go through, make sure that everyone understands what this means. So we have, unfortunately, the market has not been as great this year as it has been in prior years. So we have some positions that haven't done well, right?
yep.
And so does that mean just selling those? I mean, shouldn't, I guess I always have heard we shouldn't sell low, right? We should like buy low, sell high. So
Yep.
so if we have positions that have losses in them, does that just seems like counterintuitive that we should sell those positions?
Yeah, and it does. And that's part of the reason why often we'll say buy an index fund to try to mimic some of that so that you stay invested in the market. Typically, a lot of where we're seeing losses recognized this year is in equity markets. That's where you've seen the biggest downturn. And that's often where portfolios are hurting the most at the moment. So typically, moving step by step is you have an investment that you've made, it has gone down, and so you're going to sell it and recognize that loss. And if it is a security that you do want to hold longer term, after 30 days, you can rebuy that security. And for that 30-day period, assuming it's equity markets, you do want to maintain exposure to markets in the event we do see an upswing. You know, we've seen a few days here or there throughout this year that have been 3, 4, 5% moves in the market. So you don't want to lose exposure. And yes, I understand we tell everyone you don't want to sell low, but for this particular strategy, really what you're doing is taking a loss and turning it into an asset.
Okay, great. And what is this 30-day thing that you're talking about? Like, why can't I just sell it and then buy it after I sell it?
Yeah, so there are IRS rules, wash sale rules that basically take away the asset that you hold in tax loss harvesting if you rebuy the assets in less than that 30-day period. So no matter what you do, if you sell a security, you want to make sure you don't buy it back until 30 days later. And you can buy a similar investment that gives you very almost identical exposure, and that's not a problem. But if you're talking about recognizing a loss in a stock like Google, you need to give it 30 days before you rebuy more Google stock.
Okay, we just can't rebuy, we can't sell and rebuy that same exact stock, but we can buy another tech stock, or we can
Yep,
buy an
absolutely.
ETF that is invested in the tech sector. So those are ways of kind of like getting around this rule that kind of would prevent us from just capturing that loss and just kind of staying invested in the same stock.
Absolutely.
Great. So, so I think anybody, if you're listening, if you do have losses, then this is a great strategy to use. And you just want to be careful you don't get caught in that that wash sale rule is what it's called in the IRS rules. So make sure that you don't just repurchase the stock within the 30 days, but it is something that can be really beneficial for your investment strategy.
Yeah, and the one thing I would just re-highlight is these are losses that you can carry forward indefinitely. So even if you know that you're going to have some sort of a big gain in future years, 2, 3, 4 years down the line, maybe you recognize if you have the opportunity even more than you think you might need in 2022 so that you have access to that loss later on.
Okay. And how, I mean, can I say I have $30,000 of losses that I trigger for this year? Can I just take that and deduct that from my law firm income?
No, so it, gains and losses have to be offset with like gains and losses. So if you have a capital gain, you're going to take this capital loss and offset that. You're traditionally not going to offset a capital gain loss against ordinary income gains. So I would assume when you have these losses, you're typically sharing this information with your accountant, and they'll look at any capital gains, capital losses that you've had throughout the year, any historical capital gains that you may have, and they'll offset like for like, if that makes sense.
Yeah, definitely. And then is there any, so if we have capital gains, we can offset capital gains if we had this year. So if we had other stock that maybe actually did really well, we can take it against that, but we wouldn't be able to take it against any other income.
Ordinary income, yes.
Ordinary income. Got it. Okay.
So it's often, it's a great year if you do have gains in your portfolio, as I'm sure many people do. If you've been equity investors over the last 10, 15 years, you really haven't been able to recognize many losses, and it's been really hard to rebalance portfolios. So this has really been a year, especially this prior quarter, that we've been thinking about rebalancing portfolios for the market that we're in today.
Okay, so that's another thing maybe to look out for. If your portfolio, maybe you start with a 60-40, 60% in equities, 40% in bonds, that may be off kilter because the equity markets haven't been performing that well. So that might be something we want to take a look at as well. It's not a tax issue, but in terms of your investment and portfolio, your strategies, that might be something to think about as well. Is that right?
Absolutely. And I think that comes down to using this time at year end to really see where you are, check in on your near term and longer term goals. And if there is some broader asset allocation that you want to be shifting around, this is an easier moment to do that given what markets have done this year.
Great. Okay. So lots of opportunities to make lemonade out of lemons.
Absolutely.
Okay. What else do we have on our list of things that you check in with clients at the end of the year to either trigger deductions or whatnot in terms of their tax strategy?
Yeah, so the next biggest one, and I sort of rank these in terms of what typically moves the needle the most from a tax perspective, is thinking about charitable gifts and assets to maximize deductions. So charitable giving allows clients to utilize direct gifts, donor advised funds, private foundations to achieve philanthropic goals and generate tax deductions. There's also a lot of other entities that can be set up, and sometimes in the right situation are effective vehicles, things like charitable remainder trusts, charitable lead trusts, where you're combining investment goals with charitable objectives to enhance valuable tax deductions. But charitable gifts are typically something that we're talking to clients about earlier on in the year, and typically set a timeline of finalizing at the end of the year. And there's a lot of different ways to make your charitable gifts. Despite all of our best guidance, we always have clients that give cash gifts, and sometimes there's nothing wrong with that at all. Often where we can, we love to see clients taking appreciated securities and giving those as charitable gifts. It's a really simple and nice way to move an asset that has a gain out of your portfolio and into a charitable organization that you care about.
Okay. So tell me a little bit more about that, about why that's so beneficial. Instead of just writing a check to my favorite charity, that seems like the easiest thing to do. Why would I gift my Apple stock instead?
Yeah, so typically, especially if you take something like Apple, we just spent a lot of time talking about what the market's done this year, but still some of the biggest, call it S&P 500 stocks that many clients own and have owned for a long time still have tremendous gains built into them, depending on how long you've held them. And they're still, based on the market we've had over the last 15 years, typically a lot of rebalancing to be done in client portfolios. And so anytime you go to sell, rebalance a position like Apple, where you have often big gains, you're going to have a tax associated with that. And if you choose to use that security and gift that as part of your charitable deduction in any given year, you never have to recognize that gain. So you really achieve two goals. You've given money to a charity of choice that you care about, and you also don't have to worry about recognizing a gain in order to rebalance a portfolio or a concentration that you may have in any given stock. So it achieves a lot of different objectives. And again, there's nothing wrong with writing a check, giving cash. It certainly achieves the objective of giving to a charity that you care about. It just doesn't give you that extra bang for your buck, if you will, of rebalancing if needed and moving a capital gain away from your portfolio.
Okay, great. So let's just take an example. So say I have I have 10 shares of Apple stock that are worth, I don't know, how much is Apple worth these days? $500? I don't know. $400?
That's a great question. I'll get us the exact.
Not that you should know that off the top of your head. I have no idea.
Markets have been moving around.
It was up around like 400, dropped, and I don't know, at some point it split. So
yeah, 134 today.
134.
Not having a great day.
Okay, so not a great day. We'll just say that it's at 100. Apple stock. I bought it when it was $20 a share. It was a great investment, and
gain.
Yeah, there's an $80 gain there. And if I sold that stock, then I would have $80 in capital gains.
Right, that you're going to pay tax on should you want to reduce or completely eliminate the position. And so instead, you can gift that entire position, let's assume you're gifting it all, to your favorite charity. You can gift it through a donor advised fund. So there's a lot of different banks that have donor advised funds. There's community organizations that are local that have donor advised funds. Fidelity tends to be a big one that you see a lot of people using. That the nice part is in today's world can accept all different kinds of security. So stocks are, again, fairly simple and straightforward, and many charities are very used to receiving stock, especially Apple stock. They have the ability to sell that Apple stock. So you gift that big gain to the charity. They have the ability to sell it without recognizing any gain, because taxes, they live in a very special world where taxes don't affect them in the same way. So they get to retain all of the value of that, and you don't have to worry about that capital gain on the $80 appreciation.
Okay, great. And then I still get in terms of my charitable deduction, I would still get the whole value of that deduction in terms of the whole $100.
Yep, absolutely. And for clients, some like to give in all sorts of ways. Some have private foundations, some have donor advised funds. There's different rules and percentages of deductions based on how you're giving, what the asset looks like. But no matter what, if you have the ability to give away an appreciated asset, that's typically what we try to guide clients to give.
Okay, great. So if you are planning on making charitable gifts, then if you have appreciated stock, that might be a great way of doing that. Okay, so let's go to our next one, which I think is maximizing our retirement plan contributions.
Yes, so this is a big one that typically is, especially when we have younger clients who are starting off their careers, things like maxing out your 401k at the company that you're working for. The contribution limits for 2022 are $20,500. And it's often a really great way to reduce your ordinary income that you earn through a salary if that's how you're paid throughout the year. And often many companies have some form of a match, if you will, and rules are different from company to company, but often if you can max out, you'll get some sort of additional gift or contribution from the company that you work for as well. So we're always advising clients to max out contributions wherever they can. So whether that's a traditional 401k, whether you have your own business, you have a self-directed IRA, a SEP IRA, and just traditional IRAs. We like to say where you can max out, do. You'll get a charitable deduction. It doesn't always massively move the meter, but every dollar counts at the end of the day.
Okay. Great. Okay. Definitely a good time to look at what you have given so far. I'm sorry, contributed to your retirement plan so far, and what the maximum dollars are, because those vary depending on your income. Is that correct?
In terms of how much income, how much you can contribute to. So yes, there's a lot of different options, and sometimes smaller, especially if you have your own business, there's some interesting opportunities there as well. So it's always worth connecting with your accountant and advisors to make sure that you're maximizing contributions.
Okay, great. And then what's our next one in terms of tax planning that we have at the end of the year?
So finally, we always like to remind clients about annual exclusion gifts. So for these, we're thinking about the $16,000 annual exclusion gift that you can give to anyone that you'd like. Often we see clients giving it to children, grandchildren, however many generations down they can go. And we also think about things like paying for schooling directly, education for children, grandchildren, if you can. Again, these aren't necessarily components of this that massively are going to change your picture, but they are small things that you can do that from an overall tax planning, estate planning perspective, we want to make sure get done at the end of the year, if it makes sense for you. The one thing I'd say with all of these is we try to not tell clients that they should do any one thing purely because of a tax benefit. It's got to make sense in terms of your overall plan, your goals, and make sense for you from a cash flow perspective as well.
Okay, great. Yeah, and I want to talk a little bit about the annual gifting and the exclusion amount, because this is something I feel like there's a lot of confusion out there as to how that works and what the benefits are. So a lot of times I have clients who say, okay, if I gift any more than this exclusion amount, the $16,000 a year, we're going to have to pay tax on it. I'm going to have to pay tax on it. And that's true, but it's only for kind of a minority of people out there who have large amounts of wealth. And so we're really looking at, and at the federal level right now, the lifetime annual exclusion is close to $13 million. We still tell clients plan for around 6 million, just because the way the law is written, it's going to be going down to about 6 million in the near future, in a couple of years. But even so, a lot of people are nowhere near that amount, and they still think that this is a big issue. And so, I think what's just important to understand is that unless you expect to hit that $6 million mark over your lifetime and upon your death of what you leave, you can gift away $1 million and there's not going to be any tax on it. There's only tax once you exceed your lifetime exemption amount. So that $6 million exemption, that's something that you have. I think of it as like, it's the amount that you can give away to other people, either during your life or upon your death. And each gift that you give during your life subtracts from that overall, or reduces that overall lifetime exemption. So if I gift away $1 million to my kids, then I no longer have a $6 million exemption, I have a $5 million exemption. But that still doesn't mean I have to pay tax on that $1 million that I gifted away. It just means that I'm reducing my exemption amount. And if you are going to hit that $6 million, it makes a lot of sense to pay attention to these things, and that you want to use up that exclusion. So that exclusion just means that it's not affecting that $6 million exemption. So you can gift away to as many people as you want, that $16,000, without it affecting that $6 million lifetime exemption at all. So if you think that you're going to hit that, or if you're anywhere close to it, then it's a good idea to take advantage of this gifting exclusion. But of course, with the caveat, as Danielle said, that you want to make sure that it makes sense for you. You don't want to be giving gifts that you're going to need for your own retirement, because it's going to somehow reduce your taxes. It's only potentially, maybe you're going to have an estate tax later on down the road if you do hit that $6 million. So just, I think that's just something that I see a lot of people have some confusion about.
Absolutely. And I would just add to that, another great way is those direct gifts to education. If you're looking for further ways to move assets away without bumping up against those bigger gifting limitations.
Yeah, no, that's a great idea. And that in addition to the the $16,000 annual exclusion amount, you can also make gifts of unlimited amount, really, if you pay for someone's education or for their healthcare expenses too, I believe. And so that's unlimited, but you want to make sure that you gift it directly to
Right.
the institution. So I think, so you can't just, give your granddaughter a check for, $20,000. That's not going to count towards this exclusion. Only the $16,000 will. But if you give her a check that's written out to the university, and then she uses that to pay her tuition, then that doesn't count against the 16,000. It doesn't count against your 6 million. It doesn't count against anything. So that's a really good point. Great. Anything else that you want to share with us in terms of year end and just what you talk to clients about, and make sure that to review with them to see if there's any changes that need to be made, or actions they need to take?
Yeah, I think those are the most important items. I'd really stress once again that end of year is a great time to revisit long-term plans and recognize that if those plans were well constructed in the first place, you really don't want to go back and overhaul them due to external market conditions, or one year like 2022 where the market really moved against us. One of the key traits of a good plan is that it can succeed in a wide range of good and bad economic scenarios. And additionally, a good plan is one that hopefully can stop you from acting too strongly in volatile markets or temporary economic conditions. So we just highlight, especially this year, probably the most important one is that tax loss harvesting. Most bang for your buck right now, and probably the biggest opportunity to shift around positions in your portfolio.
Okay, great advice. And I just want to add as well, just from, it's not really a tax issue, but as we kind of visit relatives for the holidays, something that you want to do is just check in on them, see how they're doing, and make sure that they have whatever legal documents in place that they need, any kind of financial plan that they have, to see where they're at with that. If they need to start planning for long-term care, what are their care needs? Those are some things that, if you haven't seen your relatives, your older relatives for a year, then their situation could have changed. So you just want to pay attention to that, and check in with them as to what their needs are, and make sure that they have a plan in place, both financially and legally, for their estate planning. So I think that's about wraps it up. If there's any questions, you can go ahead and put them in the chat or in the Q&A or raise your hand, whichever you feel. And if there are no questions, then we will wrap it up. I just want to give Danielle an opportunity, if you can just share with our listeners how they can get in touch with you if they wanted to reach out and talk to you about some of these things that we've mentioned, or how they can work with you.
Absolutely. So I'll put my email address in the chat as well, but you can also find me on our Brown Advisory website. And please feel free to reach out. Happy to answer any questions or talk a little bit more. And thank you so much, Shannon, to you for having me today.
Sure. And I want to put in, there is an article, I think, on your website that that our listeners can check out as well, that goes into a little bit more depth.
We have a little bit of a sort of bullet pointed year-end checklist of items to highlight. Quick refresher. It's very simple and easy to access.
Yeah, so I just put that in the chat, and that has some great additional information, and also that great checklist that you can take a look at and go over for your own situation. Okay, Danielle, thank you so much for joining us. It's been great. It's such an important topic that always generates a lot of interest, and we look forward to having you back again.
Thanks so much.
Okay, take care.